Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. Today, we're discussing yet another volatile week for gold and also for silver. The two shiny metals both experienced major price fluctuations last week, with gold falling by as much as 12% on Friday the 30th of January, and silver selling off by an unprecedented magnitude of 26% the same day. Such daily price shifts have not been seen in almost half a century. So what happened? What does it mean for portfolios? And what might happen next? Well, let's hear from two of UBS's best and brightest to find out. It's a pleasure to welcome back to the show both Giovanni Staunovo, strategist in UBS Switzerland, and Wayne Gordon, strategist in UBS Singapore branch. Wayne, Giovanni, it's great to have you both with us. It's been another pretty extraordinary few days when it comes to not just gold, which we've talked about relatively recently, but also silver. Wayne, let me throw it to you just first of all, as one of our regular chroniclers of shiny metals on this program. Just bring us back up to speed. What have we seen over the last kind of 10 days or so, and what have you made of it?
Well, I haven't slept much, put it that way, Tom. Look, it was a wild ride on the way up, and it was an even wilder ride on the way down. Look, what we've experienced in the last probably, let's say, 10 days is truly historic. In fact, the rally we had in gold, and let's just focus on gold for a minute, the rally we had in gold had not been witnessed since about 1979. Now, I was a very young man then. I suspect you were just a twinkle in your father's eye. And so the reality is that the volatility we are seeing right now, we've only probably seen twice in the last 30 years or 40 years. Once when Paul Volcker became head of the Federal Reserve in the United States. And we remember back then his sharp increases in interest rates. And then around the 2013 taper tantrum, when Ben Bernanke decided it was time to take away the punch bowl. And so realistically, we should look at the volatility in both commodities, silver and gold, as well as platinum, as truly historic and unique and would not be repeated on a regular occasion. The reason I say that is because many people use gold as a hedge, rely on gold's diversification within a portfolio context. And of course, elevated volatility often scares people a little bit. But in this context, we think that once some of these leveraged long positions cleaned out of the market, I think we're still undergoing that as some of the exchanges lift the margin requirements. I think once we're through this, I think at that point, things will start to consolidate. And we expect that gold can consolidate around the 4,500 to 4,800. We would be buyers of gold there, and we would be targeting around $6,000 an ounce by the time we get into the second half of the year.
Well, let's pile in a bit more detail here, because I guess one of the interesting questions now is what this represents. And I suppose, I don't know whether it's as a journalist training one's lens, you're always trying to look for the meaning of things. Lots of people, and I'll throw this out to both of you, say, look, this is the end of the bull market for the shiny metal. Or other voices are saying, oh, look, is this just a period of greater volatility, of greater unpredictability? Giovanni, where do you sort of land on those questions? And do you understand why people want to try and say, look, this must represent the one or the other?
Well, there is a long history that people are calling a top in gold, and we keep getting surprised ourselves how much it goes on. And that's a bit reflecting the current world with a lot of geopolitical tensions and many things going on an ongoing basis. So it's a special environment. What it's a bit different than to the historical past is that at the same time, equities as well as the gold price sets a record that you would normally see in a recession, equities down, gold up, and now everything is up. And that makes a bit the historical relationship not working anymore that people tend to like to see. And therefore, some of them struggle why gold is still trading at record level. I guess our view has been always, historically, there has been one factor stopping the gold rally. It's the Fed, the US central bank, starting to become hawkish. This is still not the case. There was some uncertainty with the nomination of the new Fed chairman, that he could be perceived as a hawkish person. But effectively, we as UBS still believe that there will be 2 more rate cuts in the US this year, and that should still allow the gold price to recover to new record high later this year.
Yeah, let me just jump in on that, on a couple of things. So the first point I would make is that people are assuming that many of the statements that Kevin Walsh made a number of years ago still hold today. And in fact, when you look at some of his recent comments, it's clearly that he is much more dovish than what he was back in 2010. I think the key trigger, and while I don't think that Kevin Walsh was the reason gold prices began to roll over, and silver for that matter, it's certainly a trigger point to some profit taking, but it was more his comments around the use of the Fed balance sheet. And so his view is that it's been actively used too frequently, and he would like to see the Fed reduce the amount of liquidity they have in the market today, i.e. cut the balance sheet further. Even though Jerome Powell ceased quantitative tightening back in December. Now, the reason why I think a couple of these things are a bit incongruous is because if he was to try and reduce the balance sheet further, that would put upward pressure on long-dated Treasury yields. So we could see the 10-year and the 30-year yields sell off further. This is not something that Scott Bessent would be very happy about because it increases the funding to some degree of the US government, the interest rate they have to pay on debt, particularly as their debts continue to rise. The second point would be the relief valve for such a move would be a weaker US dollar. So even in a QT environment, remembering that we had gold rally significantly through the QT environment until Jerome Powell drew a line under it in December last year, was the weaker US dollar. So we think that any further quantitative tightening would see the US dollar sell off, Fed credibility would be somewhat damaged, and that would therefore put further upward pressure on the gold price. And in fact, when we look at the target we have of 5,900 by the end of this year, our upside risk case in that context, if we were to add in more political uncertainty post the midterms, if we were to add in more geopolitical risk when it comes to activity in the Middle East, then we could actually see an upside risk case to gold of around 7,200.
Well, we'll move on to silver in a second, but Giovanni, just wrapping up on gold, just tell me, what should investors do? As you say, there's still lots of kind of white noise in the room, lots of opinions, some of which maybe is somewhat unhelpful. What does this mean for smart investors when we're talking about gold right now? What do they need to be thinking about?
Wayne already alluded to the price setbacks are an opportunity to add exposure, particularly if you don't have an exposure. For us, it's always important to not be too much exposed to the gold allocation, but essentially to have a moderate allocation to gold in a portfolio context as it helps reduce the volatility of a portfolio. This is the function of gold, which has always worked over the past years, and that should still contribute to performance allocation. So if you don't have an allocation, just build up. If you have an elevated one, eventually make use to reduce it to more normal levels.
Wayne, let's shift our sights. More amazing data on silver. You said at the top of the program you haven't been getting.
Yeah, absolutely.
This probably wasn't helping either. Tell us what's been happening in silver.
Yeah, look, silver is even more complicated in the end. It's complicated by the fact that, it doesn't really know what it is, right? So it's half speculative asset or half an investment asset. And on the other half, it's an industrial asset. So we already have a relatively tight fundamental silver market, and it's tight for a couple of reasons. Number one, demand has picked up with respect to, as the world electrifies, we look to produce and use more solar energy, and we look to increase the number of electric vehicles on the road. And then the third thing would be, as we build out the infrastructure around AI and the broader infrastructure around increasing our production and the supply line to the destination. So these elements have seen a rise in silver demand. At the same time, we've had mine supply, which has lagged, largely because silver is not just mined individually. A large proportion of silver is actually commingled with other metals. We are seeing other metals supply also growing very slowly. So just an example, copper, we're seeing copper demand growth of around the sort of 2 to 3, slightly above 3%. We're seeing mine supply growth in copper of around 1% to 1.5%. So in that context, we have a bit of a squeeze from the supply side as well. Of course, when silver is cheap versus gold, that is, silver is trading above the gold-silver ratio of around 70 times or above, people will tend to prefer gold within a hedging context. But if silver is cheap, they will look to other metals which, relative to gold, appear cheap. Platinum and silver, to some degree of late, have been used in those contexts. So we saw a pickup in leverage bets. And of course, because it's a much smaller market, when you get, reasonable sized positioning moving in and out of a small market, it is like an elephant trying to go through a small door. And so you have congestion and you have illiquidity. And that means that prices tend to rise more and fall by more. That's why we've seen a significant pickup in volatility for silver. That being said, at these more reasonable levels, we think that silver can also consolidate.
There is two additional factors besides these structural demand and supply drivers that you have mentioned, supporting the prices in the past and causing this volatility. There is still this uncertainty if the US will introduce tariffs on imports of silver and platinum and palladium. And as a result of that uncertainty, we have seen a massive shift of these white metals out of Europe into the US. Inventories at the exchanges have increased. Essentially, this created some shortage conditions across the key markets in Europe, which historically set the price. There is less available physical metals, and that is another factor which results in the squeeze. We had also, at the start of the year, some discussion in the market that China, an exporter of silver, could come up with a ban on export or restricting exports, and that caused more volatility because there was uncertainty how much it could impact demand and supply. But this is just making the volatility even larger on the condition that already Wayne mentioned that already had an impact on price dynamics.
Maybe just a final quick thought, given that volatility and given some of those continuing unanswered questions, what's the sort of critical investment consideration? You alluded to this already, Wayne, but I guess given the fluctuating prices, that investors who want to get involved here need to have a higher risk tolerance. They need to be looking at these things always within that broader portfolio context. What do people need to keep in mind?
Yeah, sure. So look, the key thing for us is that we view gold as more of a longer term strategic hold within a portfolio context. So with gold, we like to think that people have an affinity to the metal, should be in a sort of US dollar balance portfolio. That is that traditional sort of 60-40 portfolio. We think people should be holding around 5% gold within that portfolio context. Of course, if they hold much higher volatility assets like emerging market equities, etc., the allocation should be higher. And if they have more fixed income, then the allocation can be lower. But around that 5% level is a good general sort of level to sort of think about. When it comes to things like silver, platinum, gold miners, etc., where volatility is much higher and the diversification is not as well evidently shown over time, we think these are more tactical plays. So while gold prices, now gold view is up, we are happy to be long these metals, such as silver and platinum, but we acknowledge the elevated volatility and we acknowledge the greater speculative nature of these particular metals. And in that context, we like to use options and so forth a little more to reflect our views. Whereas for gold, we take a far more broad brush to this. Depending on the client, they may wish to buy ETFs related to gold. They may wish to hold gold physically in a vault, or they may wish to also use options to get allocation to gold. So we have a far more sort of broad-based approach to that of holding gold relative to that of silver and other derivatives such as platinum or indeed gold miners, etc.
I would just add up to the great answer of Wayne that the volatility metrics. So normally gold is 10-15%. Now we are somewhere around 20%. So it's still low. But if you look at silver, which normally is 20 to 30%, now it's 60%. As you, Tom, mentioned before, it's very important that the respective risk appetite is there if you invest in these metals. But there are tactical opportunity, as we mentioned, and I guess after the recent setback, this tactical opportunity with the correct mindset regarding the risk involved to these trades, it could be there are opportunities to benefit from higher volatility and lower prices.
And that brings us to the end of this edition of the Bulletin with UBS here on Monocle Radio. Listen again and explore more at monocle.com. That's where you can join the club and subscribe to Monocle Magazine. If you want to find out how UBS can help you, head over to ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.